Hey everyone, welcome back to Corporate Decoder, the place where we try to decipher the secrets hidden deep within corporate reports. And guess what this one will tell us about the market? In this jam-packed report, we are diving into the financial health of state farm funds, and it looks like they have quite a story to tell. Make sure you are subscribed for more straight-to-the-point corporate insights. And if you want to connect with other finance enthusiasts, join our Discord community linked in the description below. Alright, let's kick things off with the State Farm Growth Fund. Now usually we see a lot of complex numbers, but this report breaks things down pretty well. They are focusing on long-term growth with a bias towards companies that have strong foundations. For the 12 months ending the 30th of September 2025, the Growth Fund actually did not do as well as the S&P 500 index. This part of the report compares how a $10,000 investment would have grown in the fund versus the S&P 500 index over 1, 5 and 10 years. Over the last year, the State Farm Growth Fund returned 15.38%, while the S&P 500 index saw a return of 17.60%. That might not sound like much, but over longer periods, compounded differences can be huge. Looking at the 10-year mark, the Growth Fund returned 13.70% annually versus the S&P 500 S15.30%. Interestingly, the Growth Fund holds a massive $8,813,282,970 in net assets. That is over $8.8 billion. They have 286 different companies in their portfolio. A big chunk of that money, 31.11%, is in information technology. Now let's switch gears and look at the State Farm Balanced Fund. This fund aims for long-term growth too, but it also mixes in some fixed income, which is basically bonds. They invest around 65% of their assets in stocks with a limit of 75%. For the same 12-month period ending the 30th of September 2025, the Balanced Fund also underperformed the S&P 500 index. The report says this was mainly because the equity portion of the fund favoured defensive factors and sectors. For the State Farm Balanced Fund, the one-year return was 10.86% compared to the S&P 500 S17.60%. Over 10 years, the Balanced Fund shows a 9.96% annual return. This is quite a bit lower than the S&P 500 index's 15.30%. The report also mentions a benchmark for bonds. This time, the Bloomberg Intermediate US Government Credit Index returned a much lower 4.01% over 1 year. This shows the bond portion likely dragged down the stock performance of the Balanced Fund. The fund has $2,605,657,434 in net assets and holds 1898 total portfolio holdings. Next up is the State Farm Interim Fund. This one is simpler. It aims to track the Bloomberg 1 to 5 year US Treasury Index, so it is mostly investing in US Treasury bonds. For the 12 months ending the 30th of September 2025, the interim fund returned 3.59%, which is slightly less than its benchmark, the Bloomberg 1 to 5 year US Treasury Index, which returned 3.77%. It seems like expenses had a small impact here, as the report states. The fund has 29,904,031 in net assets. Finally, let's decode the State Farm Municipal Bond Fund. This fund focuses on investing in securities that offer income free from federal taxes. For the 12 months ended the 30th of September 2025, it returned 2.79%. This was less than its benchmark, the Bloomberg 7-year Municipal Bond Index, which returned 3.48%. The report mentions that the fund's maturity structure was a detractor from performance and that it was underweight in certain outperforming areas like lower rated credit. The fund has 506,442,983 in net assets. Now let's look at the financials. For the State Farm Growth Fund, investments are valued at $8.8 billion. For the Balanced Fund, it is $2.6 billion. The Interim Fund holds $296 million, while the Municipal Bond Fund sits at $508 million. The Growth Fund earned $135 million in investment income. The Balanced Fund earned $61 million. The Interim Fund earned a modest $11 million, and the Municipal Bond Fund earned $17 million. Now, for the big numbers, the realized gains or losses, you can see the State Farm Growth Fund had an impressive $856 million gain. The Balanced Fund also did well with a $222 million gain. The Interim Fund and Municipal Bond Fund both had realized losses on sales of investments though. This is where Warren Buffett's philosophy comes in. He always emphasizes understanding the business behind the numbers. In this case, State Farm is managing money for countless people, and these funds represent the performance of those investments. The difference between the Growth Fund and the other funds is stark. The Growth Fund's strategy of focusing on companies with strong fundamentals and equity securities seems to have paid off handsomely in the market during this period. The Balanced Fund's inclusion of bonds likely tempered its gains. The Interim and Municipal Bond Funds are designed for lower risk, lower return profiles, and their performance reflects that. The losses in the interim and municipal bond funds from realized gains might indicate that they had to sell some investments at a loss, possibly due to market conditions or to meet redemptions, though the report doesn't give us that specific context. Looking at expenses, the growth fund and balance fund both have very low expense ratios at around 0.12%. The interim and municipal bond funds are slightly higher at 0.16%. This means for every $100 invested, only 12 to 16 cents go towards running the fund. That is incredibly efficient and likely why State Farm is emphasizing these funds. Now for some interesting tax info, the State Farm Interim Fund and Municipal Bond Fund both have significant unused capital loss carryforwards. This is essentially a tax shield, meaning they can use these past losses to offset future taxable gains. For the interim fund, it is about $19.5 million in losses, and for the municipal bond fund, it is about $15.2 million. This can be a good thing for investors as it might reduce future tax liabilities. However, it also indicates that these funds have had periods of underperformance where they needed to sell investments at a loss. Looking at the bottom line, accumulated earnings for the growth fund are over $6.7 billion, which is fantastic. The balance fund has about $1.5 billion, but the interim fund is showing a loss of over $17 million, and the municipal bond fund has a loss of over $18 million. This reaffirms that the growth focus paid off for its investors, while the more conservative funds face challenges. The report also outlines some key risks. Management risk is always there, meaning the fund managers might not always make the best calls. Market risk is also a given with ups and downs in the economy and the world we live in. Tracking risk is relevant for the interim fund as it aims to match an index and might not perfectly succeed. Liquidity risk means they might have trouble selling some investments quickly. High yield risk specifically applies to the municipal bond fund if they invest in lower quality bonds which offer higher returns but come with more risk. There is also a long-term ownership strategy risk, which means they might hold onto assets even through tough times. And of course, tax risk, which is important for municipal bonds. The report also details geographic and sector risks, which simply means that if a fund is too focused on one area, it can be hurt more by problems in that specific area. Now for my take, State Farm is clearly doing something right with its incredibly low expense ratios. For investors looking for long-term growth, the growth fund's performance, especially during this reporting period, is compelling despite not beating the S&P 500. Their strategy of focusing on solid companies seems to have paid off this time around. The balance fund demonstrates the trade-off between risk and reward, showing lower returns than pure equity funds as expected. The interim fund's performance is pretty much in line with its treasury bond benchmark. A bit of a negative drag from expenses is noted. The municipal bond fund's results show that even tax-exempt income can be volatile, and that strategy choices about maturity and credit quality really matter. The substantial losses in the interim and municipal bond funds' undistributed earnings raise an eyebrow. While the growth fund is a powerhouse with massive gains, the other funds are showing a different picture. The report is transparent about these differences, which is good. For investors, it highlights the critical importance of choosing a fund that aligns with your personal financial goals and risk tolerance. More research into the specific holdings and strategies for the interim and municipal bond funds would be warranted if you are considering them. What is your take on these State Farm funds? Let me know in the comments below. If you found this deep dive helpful, give it a thumbs up and subscribe for more. And remember to join our Discord community linked in the description for more corporate finance discussions. Thanks for watching. See you next time.